Hi everybody, it's Ryan here, and today we're going to be talking about fiscal policy, tax evasion, and tax avoidance. Now, I'm not going to claim to be an expert on this topic. If I were an expert on tax avoidance, I would be an accountant, not an economics teacher. Let's start with the definitions then. Tax avoidance is a legal way of finding ways to reduce your tax bill. In other words, you're working the system in order to make sure that your tax bill is reduced. Tax evasion is illegal because you're reducing your taxes by not fully reporting all earnings and income. In other words, you're lying about what you're earning. So how does tax avoidance work? Remember, the goal is to reduce tax through legal means. So in this example here, we've got a sole trader, Alex, and Alex has got customers, and of course, they exchange money for the product that Alex provides. And if Alex is on the higher rate of income tax of 40%, it would mean that Alex's income from this £100 transaction is £100. The tax on this new income is £40, and so Alex gets to take home £60 of this because of the tax bracket that Alex is on. So if Alex wanted to avoid paying tax, there are perfectly legal ways of doing this. The main method would be to say, let's find some deductions. Let's find accounting things that we can deduct from our pre-tax bill before we pay tax on it in order to make sure that we have a lower tax bill. So if Alex has got this business, well, maybe Alex has got a company car. And because it's a company car, it's listed as a business expense. So it's not Alex's income. It's something that Alex has had to pay out for the business. They can still use that company car, but it's not part of their taxable income. Maybe Alex is paying into a pension, and pension payments are typically deducted from tax, and so therefore not taxable. Maybe Alex has some expenses, for example, entertaining a favorite client, taking them out for dinner, and so therefore that's a business expense, which is not taxable. And then maybe there's a business conference in Florida that Alex has got to go to. And so therefore, £20 of this £100 is going on this expense of going to Florida for this business conference, which is not taxed because it's part of the business. That had to be paid in order for the business to run, supposedly. And so at the end of the day, after all of these expenses, there's only £20 of actual income. Even at the 40% tax bracket, now that has been reduced to £8. And so as you can see, there used to be a £40 tax bill, and now there's only an £8 tax bill. So successfully avoided paying tax, and all through, of course, perfectly legal means. Another example I like to think about in terms of tax avoidance is getting people in your family to work for you legally. And so this is an example that I have. Let's say that we've got Cole, who is a sole trader. Now, Cole's doing pretty well. They've got business earnings of £60,000. And so to work out the tax that's owed, if that £60,000 is considered Cole's income, therefore Cole has got a tax-free allowance of $12,500, no tax on that. There is a basic rate to pay on the $37,500 up to between $12,500 and $50,000, so $7,500 there. And then the £10,000 above $50,000 would have the 40% tax on. So therefore, £4,000 of tax on that £10,000 above it. So for a total tax bill of £11,500. Now you think, Cole, that's all right. You've done well. You've earned some money, and so therefore you pay your tax, and I suppose that's fine. But there is one way that Cole could avoid paying some of that tax if we thought of a parallel universe. So there's still our sole trader Cole, but now Cole has got a spouse. And the spouse is part of the same household. The household income is shared. It's paid for their family expenses. And so therefore, how can we work out that Cole and their spouse will pay lower tax? Well, one thing that you could do is put the spouse onto the business as an employee, pay the spouse, and we'll see how that could avoid paying some tax. So the business earnings are still £60,000 as before, but now because the spouse payment is an expense for the business, there's a £12,000 payment for a wage for one of the employees, which then means that Cole's earnings after that is taken away is now only £48,000, less than it was before. So to work out the tax liability for the household now is you'd say that Cole owes tax still has a tax-free allowance of $12,500, then has to pay basic rate on the money above the $12,500 cutoff at 20%, which is $7,100, but now no higher rate of tax because no longer earning over $50,000. And then Cole's spouse actually doesn't pay any tax because all of that tax is on a tax-free allowance of £12,000. And so therefore the household liability is only £7,100. And as you can see, that is much lower than the $11,500 that it originally was. I've got a friend of mine who works as a plumber, and they said that their spouse is on the books and is paid this exact arrangement because it's just one more way of getting $1,000 a month tax-free out of the business. As an example of more sophisticated tax avoidance, let's have a look at a coffee shop. Now, I'm not going to name names. Let's just say that it's a coffee shop called Coffee Shack with a generic logo like the one you see before you. And let's say that this coffee shop has done fairly well for themselves in the UK. So sales of £400 million, even a conservative estimate of 50% profit margin would give them profits of £200 million, which would mean that they then pay corporation tax of 19% on that £200 million profit. Now, as a corporate citizen, you might say that that's what you get for being in society. You pay tax so the government can provide the services that then enable you to be in a society where you can trade and sell coffee to the population. But of course, if you are Coffee Shack and you can avoid paying tax, then you would try to do that. Now, as it is, if this were a global coffee company, which existed in the UK but had other branches and a larger organization around the world, they might set themselves up so that the UK Coffee Shack was its own separate legal entity. So there's a Coffee Shop UK Limited, which exists in the UK, and then there are other legal entities across the world, one in, say, Luxembourg that might be the parent company that supplies Coffee Shack with its intellectual property, licensing agreements, things like that, which is domiciled in another country where maybe the taxes are lower. And so what happens in this situation is that Coffee Shack UK makes £400 million of sales here in the UK. But because they are part of a larger multinational organization, they might have an agreement where they have costs, for example, their licensing, maybe their materials, maybe they have to buy their coffee from Coffee Shack Luxembourg, a completely separate legal entity, and maybe these costs amount to, say, £399 million. What that would mean then is that Coffee Shack UK Limited only has profits of £1 million. Despite their high sales, they're not a very profitable company, which means that for their UK corporation tax liabilities, they only pay corporation tax on £1 million. So 19% of that 1 million is only 190,000, which is actually only less than 1% of their overall sales revenue. So as you can see, this is a bit more of a sophisticated and convoluted way of avoiding paying tax, but which for Coffee Shack in this instance makes a lot of sense. It really reduces their tax liability. And they have done that perfectly legally. But this was a very real example. In 2012, Starbucks got into some pretty hot water because it turned out that they'd paid £6.8 million in UK tax in 14 years. Have a look at this. They had £3 billion in sales over the course of a 14-year period, but that came out to less than 1% in corporation tax. Definitely have a read of the article because it details how Starbucks reported 5 consecutive years of losses in the UK and therefore paid zero corporation tax, even though it had internal memos to its investors saying that it was very happy with the performance and the profitability of UK stores. This stuff with Starbucks was really, really big news in 2012, and it's still quite relevant because big multinational corporations like Amazon, Facebook, Starbucks, they can get away without paying tax because they cross international borders. It's very easy for them to avoid paying. It's important to be able to contrast tax avoidance, which is perfectly legal, with tax evasion, which is illegal. The way to explain this is to say that the goal of tax evasion is to hide what you're earning. Now, oftentimes what this might mean is that if you find somebody who's saying, I'd like you to pay me in cash, that's not always, but it is often an indicator that somebody is trying to evade paying their tax. Because if you pay for something in cash, you have a transaction that takes place, but because it's paid in cash, There's no invoice. There's no record of the transaction having taken place. And so therefore, according to HMRC, if HMRC came in and said, well, what happened with this transaction? The sole trader might just say, well, transaction? What transaction? This transaction actually never happened, right? I never provided that product. I never took this cash, even though, of course, that would be a lie, because cash is a means of being able to hide that transaction. And in this case, you'd say that Alex has an income of £100, but because it's all in cash and none of it's reported, they can say, well, I've got actually zero reported income, which means that I've got zero tax to pay, and my take-home income is therefore £100, the entire lot. I would encourage you, if you know any small business owners, to ask them about what it means if somebody pays in cash and whether or not they like it and the reasons why they do. Now, there are some very interesting moral questions that come up with this. Tax evasion is very clearly illegal. Don't do it. Tax avoidance, on the other hand, everybody does it. If you've got an accountant, you're paying them to find ways of minimizing your tax liability. If you're putting money into a pension, the government is actually encouraging you to avoid tax because they want you to do something that is interesting and extra. So there's not really a cut and dry sort of, is this wrong, is this right? It's just sort of a gut feeling, how far do you take that tax avoidance before it becomes something which is properly just black and white, like that is wrong, you shouldn't be doing that. And that's really a question that is not really answered by economics. It's just sort of down to what people's perceptions are of it. Thanks for watching, everybody. I hope you found it useful. If you did, please make sure that you give it a like. Make sure you check out the description for other interesting links on this topic. And please make sure you subscribe for more videos.